Question 1. An applicant for a California life insurance license must complete a minimum of how many hours of pre-licensing study for the life-only agent license? A. 20 hours of approved pre-licensing study and 12 hours of ethics. B. 20 hours of approved pre-licensing study and 4 hours of ethics. C. 40 hours of approved pre-licensing study, including 12 hours of ethics. D. 52 hours of approved pre-licensing study, including 12 hours of ethics. Answer: B. 20 hours of approved pre-licensing study and 4 hours of ethics. In California, an individual seeking a life-only agent license is required to complete 20 hours of approved pre-licensing study covering general insurance principles and life insurance concepts, along with an additional 4 hours specifically dedicated to ethics and the California Insurance Code. This total of 24 hours ensures that prospective agents have a foundational understanding of the industry and ethical conduct before they can be licensed. Remember, specific pre-licensing education requirements are set by state law to protect consumers and ensure agents are adequately prepared. Question 2. Which of the following statements regarding the incontestability clause in a California life insurance policy is true? A. The insurer can contest the policy for fraud at any time, even after 2 years. B. The insurer cannot contest the policy for any reason after 2 years from its issue date. C. The clause prevents the insurer from denying a claim based on misrepresentations after the policy has been in force for a specific period, usually 2 years. D. The incontestability clause applies only if the insured dies within the first 2 years of the policy. Answer: C. The clause prevents the insurer from denying a claim based on misrepresentations after the policy has been in force for a specific period, usually 2 years. The incontestability clause is a standard policy provision designed to protect the policy owner from an insurer rescinding the policy due to misstatements made in the application after a certain period, typically 2 years in California. After this 2-year period, the insurer generally cannot contest the validity of the policy, even if there were material misrepresentations or concealment, unless it was for fraud or non-payment of premiums. This clause provides assurance to the policy owner that the policy's enforceability will not be endlessly challenged, giving them peace of mind that their coverage will be secure. Question 3. What is the primary purpose of the California Life and Health Insurance Guarantee Association, CALHIGA? A. To regulate insurance companies and license agents in California. B. To protect policy owners, insureds, and beneficiaries from the insolvency of life and health insurance companies. C. To provide a fund for insurers to pay claims during economic downturns. D. To educate the public about life and health insurance products. Answer: B. To protect policy owners, insureds, and beneficiaries from the insolvency of life and health insurance companies. The California Life and Health Insurance Guarantee Association, CALHIGA, is a state-mandated organization that provides a safety net for policy owners in the event that a member life or health insurance company becomes insolvent or unable to meet its contractual obligations. CALHIGA steps in to pay covered claims and continue coverage, within certain limits, protecting consumers who might otherwise lose their benefits. It's a crucial consumer protection mechanism, similar to how the FDIC protects bank deposits, ensuring that policy owners do not suffer significant financial losses due to an insurer's failure. Question 4. In California, what is the minimum free look period for a life insurance policy issued to an insured age 60 or older? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. The free look period, also known as a right to examine period, allows a policy owner to review a new insurance policy after delivery and return it for a full refund of premium if they are not satisfied. While standard life insurance policies typically have a 10-day free look period, California law specifically extends this to 30 days for policies sold to individuals who are age 60 or older. This extended period provides additional protection for senior citizens, allowing them more time to consider their purchase and ensure it meets their needs without penalty. Question 5. All of the following are typically considered standard exclusions in a life insurance policy, except A. Suicide within the first 2 years of policy issue. B. Death resulting from an act of war. C. Death while participating in hazardous recreational activities. D. Death due to accidental causes. Answer: D. Death due to accidental causes. Life insurance policies are designed to pay a death benefit for the death of the insured, regardless of cause, unless specifically excluded. Standard exclusions often include suicide, usually for a limited period like the first 2 years, acts of war, and certain aviation activities, unless the insured is a fare-paying passenger. Death due to accidental causes is precisely what a life insurance policy is intended to cover and is never a standard exclusion. In fact, many policies offer an accidental death benefit rider that pays an additional amount if death is accidental. Question 6. A life insurance policy's cash value may be surrendered for its accumulated value, which is known as which non-forfeiture option? A. Extended term. B. Reduced paid up. C. Cash surrender value. D. Automatic premium loan. Answer: C. Cash surrender value. When a whole life policy owner decides to terminate their policy before the insured's death or policy maturity, they have non-forfeiture options available to them, meaning they won't forfeit the cash value they've accumulated. The cash surrender value option allows the policy owner to receive the accumulated cash value as a lump sum, minus any outstanding loans or charges, effectively ending the policy. The other options, extended term and reduced paid up, continue coverage using the cash value, but only the cash surrender option gives the policy owner immediate access to the cash. Question 7. According to California law, an insurance producer's license is issued for a period of A. 1 year. B. 2 years. C. 3 years. D. 4 years. Answer: B. 2 years. In California, an insurance producer's license, including a life-only agent license, is issued for a period of 2 years. To maintain the license, agents must complete continuing education requirements and renew their license biennially. This 2-year cycle ensures that agents remain current with industry knowledge and regulatory changes, helping to protect consumers and maintain professional standards. Question 8. What is the purpose of a policy summary in a life insurance contract, as required in California? A. To serve as the complete insurance contract. B. To provide detailed financial information about the specific policy being considered. C. To explain the general features and benefits of life insurance in a generic way. D. To outline the agent's commission structure. Answer: B. To provide detailed financial information about the specific policy being considered. In California, a policy summary is a vital disclosure document that must be provided to a prospective life insurance policy owner at or before policy delivery. It is a personalized illustration that outlines specific key information about the proposed policy, such as the policy's name, the insuring company, premium amounts, dividends, if applicable, cash surrender values, and death benefits at specific ages. Unlike a buyer's guide, which provides general information, the policy summary is tailored to the specific policy being purchased, helping the consumer understand its particular financial aspects. Question 9. An agent engaging in an unfair trade practice by making statements that unfairly compare their products to those of another insurer to the detriment of the other insurer is committing which of the following? A. Rebating. B. Defamation. C. Twisting. D. Misrepresentation. Answer: B. Defamation. Defamation is an unfair trade practice where an agent makes false or malicious statements about another insurer's financial condition, policies, or methods of doing business, intending to injure the reputation of that insurer. This practice is prohibited because it creates an unfair competitive environment and can mislead consumers. For example, falsely claiming another company is on the verge of bankruptcy to steer a client away from them would be defamation. Question 10. Which of the following is the best description of a MEC, Modified Endowment Contract, in California life insurance? A life insurance policy that allows for flexible premiums and death benefits. B. A life insurance policy that has been overfunded according to IRS rules, causing it to lose its tax-favored status on cash value withdrawals and loans. C. A term life insurance policy that can be converted to a whole life policy. D. A policy designed specifically for retirement planning with guaranteed growth. Answer: B. A life insurance policy that has been overfunded according to IRS rules, causing it to lose its tax-favored status on cash value withdrawals and loans. A modified endowment contract, MEC, is a life insurance policy that fails the 7-pay test, meaning the premiums paid into the policy during its first 7 years exceed the amount required to fully pay up the policy within 7 years. Once a policy becomes a MEC, its cash value withdrawals and loans are treated as last in, first out, LIFO, for tax purposes, meaning taxable gain is presumed to be withdrawn first, and these distributions are subject to ordinary income tax and potentially a 10% penalty if taken before age 59 and a half. This designation is critical because it significantly changes the tax treatment of the policy's cash value. Question 11. An individual has a life insurance policy with a cash value. They want to access some of this cash without giving up the death benefit entirely. Which policy provision allows them to do this? A. Reinstatement provision. B. Policy loan provision. C. Conversion privilege. D. Entire contract provision. Answer: B. Policy loan provision. The policy loan provision allows a policy owner to borrow money from the insurer, using the policy's accumulated cash value as collateral. The loan amount is usually limited to the policy's cash value, and interest is charged on the loan. If the loan is not repaid by the time of the insured's death, the outstanding loan balance and any accrued interest are deducted from the death benefit paid to the beneficiary. This is a common way for policy owners to access funds without surrendering the policy or completely terminating coverage. Question 12. Which of the following is not typically considered a valid reason for an insurer to deny an applicant for life insurance coverage in California? A. The applicant has a hazardous occupation. B. The applicant has a severe medical condition. C. The applicant is of a specific race or ethnic background. D. The applicant has a history of dangerous hobbies. Answer: C. The applicant is of a specific race or ethnic background. Insurance companies are prohibited from discriminating against applicants based on protected characteristics such as race, color, national origin, religion, sex, marital status, or sexual orientation. Underwriting decisions must be based on actuarially sound principles related to risk, such as health status, occupation, and dangerous hobbies, which directly impact the likelihood of loss or mortality. Denying coverage based on race or ethnicity is illegal discrimination and an unfair underwriting practice. Question 13. A life insurance policy that provides coverage for a specific period and does not accumulate cash value is known as A. Whole life insurance. B. Universal life insurance. C. Variable life insurance. D. Term life insurance. Answer: D. Term life insurance. Term life insurance is designed to provide coverage for a specified period, or term, such as 10, 20, or 30 years. Unlike permanent life insurance policies, term life insurance does not build cash value and therefore has no loan or surrender value. If the insured dies within the policy term, the death benefit is paid. If they outlive the term, the policy expires with no payout unless renewed. It's often chosen for its affordability and suitability for temporary needs like covering a mortgage during its repayment period. Question 14. What is the primary purpose of the insuring clause in a life insurance policy? A. To define the policy owner's responsibilities. B. To state the insurer's promise to pay the death benefit upon the insured's death. C. To outline the policy's exclusions and limitations. D. To describe the premium payment schedule. Answer: B. To state the insurer's promise to pay the death benefit upon the insured's death. The insuring clause, or insuring agreement, is the core of the insurance contract and is typically found on the policy's first page. It explicitly states the insurer's fundamental promise to pay the policy's face amount, death benefit, to the designated beneficiary upon proof of the insured's death, provided all conditions of the policy are met. This clause legally binds the insurer to its primary obligation under the contract. Question 15. In California, if a life insurance policy lapses due to non-payment of premium, how long is the grace period during which the policy owner can pay the overdue premium to prevent the policy from terminating? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. In California, standard individual life insurance policies are required to include a grace period of 30 days, or 1 month, after the premium due date. This grace period allows the policy owner additional time to pay the overdue premium without the policy lapsing. If the insured dies during this grace period, the death benefit is paid, but the overdue premium is typically deducted from the payout. Industrial life policies, however, have a 60-day grace period in California. Question 16. What is the main difference between a revocable and an irrevocable beneficiary designation? A. A revocable beneficiary can be changed by the policy owner at any time. An irrevocable beneficiary cannot be changed without their consent. B. A revocable beneficiary receives benefits immediately. An irrevocable beneficiary receives them only after a waiting period. C. A revocable beneficiary is always a family member. An irrevocable beneficiary is always a trust. D. An irrevocable beneficiary must be named at policy inception. A revocable beneficiary can be added later. Answer: A. A revocable beneficiary can be changed by the policy owner at any time. An irrevocable beneficiary cannot be changed without their consent. The distinction between revocable and irrevocable beneficiaries is crucial in life insurance. A revocable beneficiary designation means the policy owner retains the right to change the beneficiary at any time without their consent. Conversely, an irrevocable beneficiary designation means the policy owner cannot change the beneficiary, take a policy loan, or surrender the policy without the named beneficiary's written consent. This gives the irrevocable beneficiary a vested interest in the policy, providing a higher degree of security for their future benefit. Question 17. Which of the following is considered twisting in the context of life insurance in California? A. Offering a prospective client a portion of the agent's commission as an inducement to buy a policy. B. Misrepresenting the terms of an existing policy to induce a policy owner to surrender it and purchase a new one from the same agent or company. C. Making false statements about the financial condition of another insurer. D. Charging excessive fees for insurance advice. Answer: B. Misrepresenting the terms of an existing policy to induce a policy owner to surrender it and purchase a new one from the same agent or company. Twisting is an illegal unfair trade practice where an agent induces a policy owner to lapse, forfeit, or surrender an existing policy to purchase a new one, based on misleading or incomplete comparisons of the two policies. This typically involves misrepresenting the benefits, advantages, or disadvantages of the existing policy, often to the policy owner's detriment. The goal is often to generate a new commission, even if the new policy is not in the client's best interest. Question 18. An individual purchasing a life insurance policy must demonstrate insurable interest in the life of the insured. When must this insurable interest exist? A. At the time of the insured's death. B. At the time of policy application. C. Throughout the entire duration of the policy. D. At the time the death benefit is paid. Answer: B. At the time of policy application. Insurable interest is a fundamental principle of insurance, requiring that the policy owner stand to suffer a financial or emotional loss if the insured dies. For life insurance, this insurable interest must exist at the time the policy is purchased or applied for, not necessarily at the time of death. For example, a spouse has an insurable interest in their partner, or a business might have an insurable interest in a key employee, at the point they apply for coverage. Question 19. All of the following are characteristics of whole life insurance, except A. Level premium for the life of the policy. B. Accumulates cash value that can be accessed. C. Death benefit remains constant throughout the policy's life. D. Designed to cover a specific period, typically 10, 20, or 30 years. Answer: D. Designed to cover a specific period, typically 10, 20, or 30 years. Whole life insurance is a type of permanent life insurance designed to provide coverage for the entire life of the insured, as long as premiums are paid. Its key characteristics include a level premium, guaranteed cash value accumulation, and a level death benefit. The characteristic of being designed to cover a specific period, typically 10, 20, or 30 years, describes term life insurance, not whole life. Question 20. If a policy owner borrows from their life insurance policy's cash value and dies before repaying the loan, what happens to the death benefit? A. The death benefit is forfeited entirely. B. The outstanding loan balance and accrued interest are deducted from the death benefit paid to the beneficiary. C. The beneficiary is responsible for repaying the loan. D. The insurer forgives the loan and pays the full death benefit. Answer: B. The outstanding loan balance and accrued interest are deducted from the death benefit paid to the beneficiary. When a policy owner takes a loan against their life insurance policy's cash value, it is not a traditional loan from a bank but rather an advance from the policy's own value. If the insured dies before the loan is fully repaid, the insurer will subtract the outstanding loan amount, plus any accrued interest, directly from the death benefit payable to the beneficiary. This ensures the insurer is reimbursed for the advanced funds while the beneficiary still receives the remaining proceeds. Question 21. What is the primary purpose of a buyer's guide when purchasing life insurance in California? A. To provide specific details about the chosen policy, including premiums and cash values. B. To offer general information about life insurance, helping consumers make informed decisions. C. To list all available riders and their associated costs. D. To serve as a legally binding part of the insurance contract. Answer: B. To offer general information about life insurance, helping consumers make informed decisions. In California, Buyer's Guide is a generic informational booklet that explains the basic types of life insurance, how they work, and factors to consider when purchasing a policy. It is designed to help consumers understand life insurance in general terms and compare different options available in the market. This guide is usually provided at the time of application, or no later than policy delivery, complementing the more specific policy summary, which details the proposed policy's financial aspects. Question 22. Which rider ensures that a life insurance policy will not lapse due to non-payment of premium if the insured becomes totally and permanently disabled? A. Waiver of premium rider. B. Accidental death benefit rider. C. Guaranteed insurability rider. D. Payer benefit rider. Answer: A. Waiver of premium rider. The waiver of premium rider is a valuable feature that, if added to a life insurance policy, ensures that the policy remains in force without the policy owner having to pay premiums if they become totally and permanently disabled. There is usually a waiting period before benefits begin, example 6 months, and the disability must meet the policy's definition. This rider is designed to prevent a policy from lapsing during a time of financial hardship caused by disability, offering critical protection. Question 23. An agent receives a notice from the California Department of Insurance, CDI, regarding an alleged unfair claim settlement practice. Who is responsible for investigating such complaints? A. The agent's employing insurance company. B. The National Association of Insurance Commissioners, NAIC. C. The California Department of Insurance, CDI, specifically the Insurance Commissioner. D. The policyholder's attorney. Answer: C. The California Department of Insurance, CDI, specifically the Insurance Commissioner. The California Department of Insurance, CDI, headed by the Insurance Commissioner, is the primary regulatory body responsible for overseeing the insurance industry within the state. This includes investigating complaints against agents and insurers regarding unfair trade practices, including unfair claim settlement practices. The CDI ensures that all insurance companies and agents operating in California comply with state laws and regulations, protecting consumers from unlawful or unethical conduct. Question 24. A policy owner changes the beneficiary designation on their life insurance policy from their spouse to their child. This action is known as A. Assignment. B. Reinstatement. C. Modification. D. Change of beneficiary. Answer: D. Change of beneficiary. A change of beneficiary is the specific action a policy owner takes to alter who will receive the death benefit upon the insured's passing. This is typically done by submitting a written request to the insurance company, and if the beneficiary was revocable, the change takes effect without their consent. This provision allows policy owners to adjust their estate plans as life circumstances change, ensuring the policy proceeds go to their intended recipients. Question 25. Which of the following best describes the entire contract provision in a life insurance policy in California? A. The policy document is the only part of the contract. B. The policy, including a copy of the application and any riders or amendments, constitutes the entire agreement between the policy owner and the insurer. C. The contract includes the policy and any oral agreements made during the sales process. D. The policy can be changed by the insurer at any time without notice. Answer: B. The policy, including a copy of the application and any riders or amendments, constitutes the entire agreement between the policy owner and the insurer. The entire contract provision states that the insurance policy itself, along with a copy of the application, if attached, and any attached riders or amendments, represents the complete and sole agreement between the policy owner and the insurer. This provision is crucial because it prevents either party from referring to any documents or statements not contained within the contract to argue for or against a claim. It ensures that everything the policy owner needs to know about their coverage is explicitly stated within the four corners of the document, protecting them from unexpected terms or conditions.